Silver just moved $5 in a single day, climbed 4%, before most people even finished their morning coffee. And somewhere in Washington, a warning was delivered to Tehran that was not meant for the evening news. It was meant to be felt in the markets. The markets don't lie. They don't panic without reason. And right now, they are screaming something that most people are not yet ready to hear. The question is not if something is coming. The question is, how much time do you have left to prepare? Welcome to Metal and Macro, the place where global events are decoded through the language of money. Now, before we go any further, if you have not yet subscribed to this channel, think of it this way. You wouldn't leave the house in a storm without first checking the forecast. This channel is your forecast. Hit that subscribe button the same way you'd fasten your seatbelt before a long drive. Quietly, wisely, and without waiting to be asked twice. And one more thing, we want to know, where in the world are you watching from today? Drop your city, your country, right there in the comments below. Because the story we are about to tell you affects every corner of this globe. Now, let us begin. It began with words, not missiles, not sanctions, not a formal declaration of any kind. But in the world of global finance, words spoken by the right person at the right moment carry the same weight as a cannon fired across open water. On that particular day, the former and now returning force in American politics, Donald Trump, issued a direct caution to Iran. The statement was measured, it was deliberate. And to anyone who has studied how great powers communicate before conflicts escalate, it was unmistakable. This was not a tweet written in anger. This was not political theater designed for domestic audiences. And the markets, as they always do, heard it first. Within hours of that caution being delivered, something remarkable happened across trading floors from New York to London to Shanghai. Silver, the metal that most ordinary people associate with jewelry and old coins, suddenly surged $5 in a single session. $5. For context, a move of that size in silver does not happen because of seasonal demand or minor economic data. It happens when serious money, institutional money, begins moving with urgency. A 4% climb in crude prices sent an immediate ripple through energy markets. Manufacturing costs, everything connected to oil, began quietly recalculating. And yet, on that same day, the mainstream conversation was elsewhere. Most people were watching other headlines. Most people were not paying attention to what the metals and energy markets were whispering to those who knew how to listen. This is exactly how it has always worked. Those who study economic history understand something that the average person does not. They understand that before major geopolitical conflicts fully materialize, before troops move, before official statements are made, the financial markets begin pricing in the probability of that conflict weeks in advance. It happened before the Gulf War. It happened before the Iraq invasion of 2003. It happened in the months preceding every significant Middle Eastern escalation of the last 4 decades. Smart money does not wait for confirmation. Smart money moves on probability, and right now, the probability that something serious is developing between the United States and Iran is being reflected not in political commentary, but in the price of silver and oil. The question is whether the audience is listening. To understand why a single caution from Donald Trump can move global commodity markets, one must understand the history of U.S.-Iran relations and what American warnings have historically preceded. Iran sits at the center of one of the world's most critical energy corridors. It controls significant influence over the Strait of Hormuz, the narrow passage through which nearly 20% of the world's oil supply travels every single day. When the United States and Iran enter a period of direct confrontation, the entire global energy supply chain holds its breath. Traders know this. Institutions know this. The sovereign wealth funds of major nations know this. So when a man with the political weight of Donald Trump issues a formal caution to Tehran, and when that caution carries with it the tone of finality rather than negotiation, experienced market participants do not wait for a second warning. They move capital, they reposition, they buy hard assets, they hedge against disruption. That is precisely what happened. And that $5 move in silver, that 4% climb in oil, those were not accidents. They were answers to a question the market was already asking. Part 1 of this story ends here, but the larger story is only beginning. Because the real question is not what Trump said to Iran. The real question is what the silver market already knows, that the rest of the world has not yet figured out. There is an old saying among those who have spent decades studying commodity markets. Gold is the metal of kings. Oil is the metal of empires. But silver is the metal that tells the truth. And right now, silver is speaking, not in whispers, not in subtle technical movements that only specialists can decode. Silver is speaking loudly, urgently, and with the kind of clarity that only appears when something genuinely significant is developing beneath the surface of what the public can see. Most people looked at that $5 single session surge and thought about profit. They thought about percentages. They thought about whether they had bought early enough or missed the move entirely. But the serious analysts, the ones who have lived through multiple conflict cycles, the ones who have watched silver behave across decades of geopolitical tension, they were not thinking about profit. They were thinking about what that move was confirming. The vault that is running empty. Here is a fact that received almost no mainstream coverage on the day it happened. On a Tuesday, quietly, without fanfare, without a single major financial news outlet treating it as the headline it deserved to be, 3.4 million ounces of silver were removed from COMEX vaults in a single session. Let that number settle for a moment. 3.4 million ounces, gone, in one day. And that withdrawal did not happen in isolation. It was part of a larger drain that has been accelerating for weeks. Registered silver, the silver that is officially available for delivery against futures contracts, dropped below 90 million ounces for the first time in recent memory. It now sits at approximately 88.8 million ounces and continues to fall. To understand why this matters, one must understand what registered silver actually represents. It is not silver sitting in someone's personal safe. It is not silver held speculatively by investors hoping for price appreciation. Registered silver is the physical metal that backs the entire paper trading system. It is the foundation upon which trillions of dollars worth of silver contracts are built. When that foundation begins to erode, when physical metal starts leaving the system faster than it is being replaced, it means someone, somewhere, with enormous resources and considerable intelligence, has decided that holding paper promises is no longer acceptable. They want the real thing, and they want it now. Shanghai is sending a different message. Entirely. While Western markets were processing Trump's caution to Iran, something equally significant was unfolding on the other side of the world. In Shanghai, silver was trading at a $9 premium over the Western spot price. $9. In commodity markets, a premium of that magnitude between two major global exchanges is not a minor discrepancy to be explained away by shipping costs or minor supply differences. A $9 premium is a statement. It is the Eastern market saying, clearly and without ambiguity, that the demand for physical silver in Asia has moved beyond what normal supply channels can satisfy at current prices. China has been accumulating, quietly, methodically. The way large, sophisticated economies accumulate when they believe a fundamental shift in global conditions is approaching. They are not buying silver because they expect a modest price increase. Nations and institutions do not drain vaults and pay $9 premiums for modest price increases. They do it when they believe the world is about to change in ways that make physical hard assets worth far more than current prices reflect. This is not just a safe haven move. Here is where the silver story becomes particularly important for the business community to understand. Silver is not gold. Gold is purchased almost entirely for monetary and safe haven purposes. When fear rises, gold rises. That relationship is simple and well understood. Silver is different. Silver is simultaneously a monetary metal and an industrial metal. It is essential in solar panels, in electronics, in defense manufacturing, in medical technology, and critically, in the weapon systems and military hardware that modern conflicts consume at extraordinary rates. When silver surges during a period of geopolitical tension, it is not just fear driving the price. It is the industrial anticipation of what conflict-level production demands will do to an already tightening supply. The market is not just hedging against war. The market is pricing in what war actually consumes. What serious people are watching next? The COMEX drain, the Shanghai premium, the single-session $5 surge, taken individually. Each of these data points is interesting. Taken together, they form a picture that serious economic analysts find deeply significant. Silver is not moving because of seasonal jewelry demand. Silver is not moving because of a minor shift in industrial orders. Silver is moving because the people who move markets, the institutions, the sovereign funds, the experienced commodity desks of the world's largest financial houses, have looked at what Trump said to Iran, have looked at what the Strait of Hormuz represents to global oil supply, and have made a quiet but very decisive conclusion. They are positioning now, before the rest of the world even realizes the game has changed. There is a body of water on this planet that most people could not locate on a map. It is not particularly wide, it is not particularly deep. It does not carry the romantic historical weight of the Mediterranean or the vast strategic mythology of the Pacific Ocean. It is narrow, it is contested, and it is, without exaggeration, the single most important 21 miles of water on the face of the earth. It is called the Strait of Hormuz. And right now, every serious energy analyst, every global supply chain strategist, Every institutional investor with exposure to oil markets is watching that strait with the kind of focused attention that only appears when something genuinely dangerous is developing. Because here is the reality that most evening news programs will never explain clearly enough. If the Strait of Hormuz closes, even for a matter of days, the global economy does not slow down. It stops. 21 miles that hold the world hostage. One must first understand what Iran actually controls in the architecture of global energy. Approximately 20% of the world's entire oil supply passes through the Strait of Hormuz every single day. That is not a statistic to be read and forgotten. That is the economic oxygen supply of the modern industrial world, moving through a corridor so narrow that a determined adversary could, in theory, disrupt it with relatively modest military means. Saudi Arabia moves its oil through there. The United Arab Emirates moves its oil through there. Kuwait, Iraq, Qatar, every nation in the Persian Gulf that produces the energy that powers factories, fills fuel tanks, heats homes, and keeps global supply chains moving, depends on those 21 miles remaining open. Iran knows this. Iran has always known this. And in every cycle of U.S.-Iran tension across the last 4 decades, Tehran has made it explicitly clear that if pushed to the edge, the Strait of Hormuz is the card they will play. It is not a bluff. History confirms it is not a bluff. What 4% actually means. When oil moves 4% in a single session, the untrained observer sees a number on a screen. The experienced analyst sees something entirely different. They see the collective judgment of thousands of sophisticated market participants simultaneously repricing the probability of supply disruption. They see insurance costs for oil tankers quietly climbing. They see shipping companies beginning to reroute contingency calculations. They see the quiet acceleration of a strategic petroleum reserve conversations in Washington, Brussels, Tokyo, and Beijing. A 4% move in oil is not a reaction to what has already happened. It is a bet on what is about to happen. And the people placing that bet are not amateur retail traders following social media sentiment. They are the most informed, best resourced, and historically accurate pricing mechanisms that the modern financial system has ever produced. They moved 4% in a single day. That deserves serious attention. The historical pattern. That should concern everyone. Those who study conflict cycles and their relationship to energy markets have identified a pattern that has repeated itself with uncomfortable consistency across the last half-century. It begins with diplomatic language, shifting from negotiation to warning. Then comes a period of market nervousness, reflected in modest but accelerating commodity price movements. Then physical positioning begins. Nations quietly filling strategic reserves, institutions rotating out of vulnerable equities, smart money accumulating hard assets. And then, if the diplomatic warning goes unanswered or is met with defiance, the situation moves to its next phase. Every major U.S.-Iran escalation of the modern era has followed a version of this sequence. The Gulf of Oman incidents of 2019, the assassination of Qasem Soleimani and the immediate oil spike that followed, the drone strikes, the proxy conflicts that never quite became direct confrontations, but came close enough to remind markets exactly how fragile the energy architecture of the modern world actually is. What is happening right now fits that pattern, not perfectly. Geopolitical situations rarely follow perfect scripts, but the broad structure, the sequence of events, the market responses, they are familiar to anyone who has studied this history carefully enough. The business community's exposure is larger than most realize. For the entrepreneurs, the business owners, the young professionals watching this analysis, the oil story is not abstract. It arrives at their doorstep in very specific and very practical ways. Every business that depends on logistics, on shipping, on manufacturing, on agriculture, on any input that requires fuel to produce or transport, is directly exposed to what happens in those 21 miles of Persian Gulf water. When oil moves 4% in a day on the basis of words alone, imagine what it does when words become actions. Supply chains that seemed stable last quarter begin to fracture. Input costs that were budgeted with reasonable confidence 6 months ago become unpredictable. Margins that looked healthy begin compressing from directions that no standard business model was designed to anticipate. This is not a hypothetical future scenario being presented for intellectual interest. This is the environment that is being built right now in real time. While most business owners are focused on their quarterly numbers and their immediate operational challenges, the Strait of Hormuz does not care about quarterly numbers. The clock that is already running. There is one final element of the oil story that demands attention before this analysis moves forward. The title of this video carries a question inside it. Conflict within weeks? That is not sensationalism. That is not designed to generate fear or drive engagement. That question reflects something very specific that experienced geopolitical analysts track when studying escalation timelines. Diplomatic warnings issued at the level Trump issued his caution to Iran historically carry a response window. That window is not infinite. It is not open-ended. There's a point at which a warning, if ignored or met with defiance, must either be backed by action or permanently lose its credibility. Great powers cannot afford to lose credibility. And the markets, with oil up 4%, with silver draining from vaults, with Shanghai paying $9 above Western spot price, the markets have already made their assessment of which direction this is heading. They are not waiting for the official announcement. They never do. There's a fundamental difference between the person who watches a storm approaching and the person who has already quietly moved everything valuable to higher ground. Both individuals see the same sky. Both individuals feel the same shift in the wind. Both individuals have access to the same forecast. But only one of them will wake up the following morning with everything intact. This entire analysis, the Trump caution, the silver surge, the COMEX vault drain, the Shanghai premium, the 4% oil move, the Strait of Hormuz equation, none of it was presented to create fear. It was presented because serious people, when confronted with serious information, do not freeze. They do not panic. And they certainly do not scroll past the data and return to business as usual. Serious people plan. And right now, across the world's most experienced financial institutions, sovereign wealth funds, commodity desks, and quietly informed family offices, the planning has already begun. The first move serious money always makes. When geopolitical risk of this magnitude begins surfacing in market data, the first observable response among sophisticated institutional players is always the same. They rotate out of vulnerability and into durability. This does not mean panic selling. It does not mean abandoning entire portfolios overnight. It means a measured, deliberate, systematic shift of capital away from assets that are most exposed to conflict-driven disruption and toward assets that have historically preserved and grown value during periods of geopolitical stress. Hard assets move to the center of that calculation every single time. Gold, silver, energy, agricultural commodities, real assets with intrinsic value that no political decision, no sanctions regime, no conflict escalation can reduce to zero overnight. The $5 silver surge was not the beginning of that rotation. It was the visible surface of a rotation that had already been quietly underway for weeks beneath the data that most ordinary observers never examined closely enough. The institutions were already moving before the headline existed. That is not coincidence. That is preparation meeting information at the precise moment when both align. What the capital rotation pattern is currently showing, for those who know where to look, the fingerprints of large-scale institutional repositioning are already visible in current market data. Equity markets in sectors most exposed to oil price volatility have been experiencing quiet but persistent selling pressure. Airline stocks, petrochemical manufacturers, logistics companies with thin margins and high fuel cost exposure, these are not collapsing, but the smart money is reducing exposure, trimming positions, creating space to absorb what comes next. Simultaneously, the inflow into commodity-linked instruments has been accelerating: silver ETFs, gold futures, energy sector equities positioned to benefit from sustained high oil prices, defense industry stocks, which historically perform strongly during periods of confirmed geopolitical escalation. The rotation is not dramatic enough to dominate financial news cycles. It is not designed to be. Large institutions do not announce their repositioning. They execute it quietly, over days and weeks, so that by the time the broader market catches up to what they already know, the best positions have already been taken. This is the financial warfare that serious analysts study, not the conflict itself, but the capital movements that precede it, because those movements, read correctly, tell the entire story before the story officially begins. The entrepreneur's strategic lens for the business owners and young entrepreneurs who form a significant part of this audience. The institutional playbook offers a framework, but it must be translated into the language of operational business reality. The first and most immediate question every business owner with any exposure to oil-dependent costs must ask themselves right now is simple: how long can my current cost structure survive if oil sustains above key price thresholds for 90 days or more? Not a week. Not a temporary spike that corrects itself within a news cycle. 90 days of elevated energy costs flowing through every layer of their supply chain, their logistics, their manufacturing inputs, their customers' purchasing power. If the honest answer to that question creates discomfort, then the time to address that discomfort is now, before the confirmation, before the official escalation, before the moment when every other business owner is asking the same question simultaneously, and the solutions become expensive, slow, and scarce. Contingency supply chain planning is not pessimism. It is the most rational form of business intelligence available in an environment like this one. Identifying alternative suppliers outside conflict-exposed regions, reviewing contractual exposure to fuel surcharges, stress testing margin structures against realistic worst-case energy cost scenarios. These are not dramatic actions. They are quiet, professional, and entirely within the reach of any serious business operator who chooses to act on information rather than wait for certainty. Certainty, in geopolitical situations of this nature, always arrives too late to be useful. The threat and opportunity map. Every period of genuine geopolitical disruption in modern history has produced the same dual reality. For those who were unprepared, it produced damage, supply chain failures, margin compression, liquidity crises, business models that worked perfectly in stable conditions, suddenly revealed as dangerously fragile when conditions changed. But for those who were positioned correctly, those same periods produced some of the most significant wealth creation events of the modern era. Energy companies that held substantial reserves when oil surged during the 1973 Arab oil embargo did not merely survive. They transformed. Defense contractors during every major conflict escalation of the last century did not merely hold value. They compounded it at rates that peacetime conditions could never have generated. Silver, which sat quietly undervalued for years before previous conflict cycles, rewarded those who understood its dual role as monetary hedge and industrial necessity with returns that conventional asset classes could not approach. The opportunity map in the current environment is not difficult to read for those willing to look at it honestly. Hard asset exposure, energy sector positioning, defense industry awareness, supply chain resilience investment, geographic diversification of business dependencies away from conflict-exposed corridors. These are not exotic financial strategies reserved for billionaires and sovereign funds. They are the logical, historically validated responses of any serious decision-maker who has studied what conflict cycles do to capital and has chosen to be on the right side of that history. The final assessment here is where this analysis arrives at its most important conclusion. Trump cautioned Iran. That is a fact. Silver moved $5 in a single session. That is a fact. Oil climbed 4% on the basis of words alone. That is a fact. COMEX vaults lost 3.4 million ounces of registered silver in a single Tuesday. That is a fact. Shanghai is paying $9 above Western spot price for physical silver delivery. That is a fact. These facts do not exist in isolation. They are connected. They are telling a single coherent story to anyone with the discipline to read them together, rather than dismissing each one individually as market noise. The story they are telling is this: the world is repricing risk systematically, with the kind of institutional seriousness that does not appear in markets unless the people closest to the most sensitive information have concluded that something significant is approaching. Whether that something materializes into open conflict, into targeted military action, into a negotiated resolution under pressure, or into a prolonged period of elevated tension that reshapes energy and commodity markets for months or years. The time to prepare is not after that answer becomes clear. The time to prepare is now. While the information is still early, while the positions are still available, while the cost of being wrong about the timeline is still far lower than the cost of being right, and having done nothing.